I've been very blessed on my journey as a dividend investor. In addition to having the good fortune and the blessing of God to be able to outperform the broader market, since embarking on this journey, I've also been blessed to learn a lot about myself, about how the world works, about how individual companies and industries work, and ultimately about investing. And it's taught me a lot of humility, taught me a lot about having patience and courage and conviction, and so many other things. But of course, I've also learned a lot, perhaps more than anything, through the investing mistakes that I've made. Some of the biggest mistakes I've made have been selling stocks like Palantir, selling stocks like Apple way too early in the process. Or perhaps I doubled down on some stocks that were in free fall and I thought were dirt cheap, but I misunderstood the balance sheet or the business model and therefore end up being left holding the bag on a dividend cutter or a dividend eliminator and lost a lot of money in the process. Other mistakes I've made have been simply just completely missing some opportunities because I just didn't have the courage of my convictions and wasn't willing to put money out there. But the single biggest regret that I have as an investor is not properly determining which category of company it is that I'm analyzing at the time of particularly buying or considering selling. Now, I will detail this more in this video. Before I get into it, if you could please like the video. That'd really help increase its distribution. I'd greatly appreciate it. Thank you so much. Okay, so what does this mean? Not properly categorizing a company or a stock that I'm analyzing. Well, it really boils down to knowing whether or not a stock fits into one of three buckets. And those three buckets are, it's either a growth stock, it's a stalwart stock, or it's a cyclical stock. Now, the growth stocks are ones that have long growth runways. They typically pay out little or no dividends, but they have very long growth runways. They usually have excellent management teams. They have very innovative business models, or at the very least employees. And so they're not only able to generate attractive growth in the near term, but they're often able to, the best ones, the very best ones are able to innovate to continue to extend their growth runway further and further and further. Great example of this is Apple. You know, they had a big winning product with the Mac, then they had the iPod, and then they had, the iPad, and then they had the iPhone, and they're riding that iPhone wave. Now they're investing in AI, and we'll see what they come up with next. They're trying to innovate with new products. You see this going on with Alphabet and Meta, Amazon, and really all the big tech companies like that are consumer facing, especially. They're trying to innovate in new products, new innovations using their high tech employee base to try to innovate to extend their growth runways further and further and further. You see this in the asset management space. For example, with Brookfield, they had their good core competencies and they've just gradually added companies over time. They had real estate was their bread and butter along with infrastructure. And then they added renewable power. Then they added private equity. And now they're adding insurance and other businesses, credit, et cetera, on top of that to continue to extend their growth runway. They continue to add platforms, add expertise, innovate within house to add new businesses to continue extending their growth model further and further and further. So if you just value them based on their, core business years ago, you would not expect them to continue to be growing at the pace they are today, but that's because they're innovating, adding more. Tesla's another example. They got the car business. That's cool. That's exciting, but they're investing in robots and the Optimus, the robot, they're investing in autonomous driving, and they're investing in other projects as well to continue to grow the growth runway and innovate. So these kind of companies are tremendous potential long-term compounders of wealth. Again, if you pick the right ones, you can also pick the wrong ones and they fail to innovate and then they come crashing down once their growth rate dries up. And so, these can be great, but they're typically very hard to value because of the uncertainty about just how fast they'll be able to grow, for how long, and whether the innovation is going to really kick in or management loses track of their vision or mission. And so with these, I think the best approach is to not even worry about trying to value them. Instead, just look at, okay, obviously you don't want to just pay any price, but look at, okay, is this a relatively opportunistic time to buy into this company based on, has it dipped recently? Has it gone on a tremendous run? You think that there is considerable growth for the foreseeable future. There are no big warning signs. You believe in management. You believe in the mission, et cetera. You believe in the moat around the existing business. And then you buy in. You don't worry about the valuation. You just let it run. And you diversify across many holdings, and ideally your winners will outweigh your losers. If the losers crash and burn, you can, and again, these are ones you probably want to hold in a taxable account because they don't typically pay much in the way of dividends. The winners you'll just let run and run and run, potentially forever, or at the very least well into the future. Then you can sell for long-term capital gains. Whereas the losers, you'll sell and you'll get that nice tax write-off. You don't want to hold a loser in an IRA, for example. So I would say with these ones, they're nice to hold in a taxable account. Again, it's not tax advice. It's just my personal approach to it. But those you just want to hold and let them run, not worry about buying or selling them, trying to, figure out the valuation, etc. Then the next category, the stalwarts. Now, these are the ones that you can really apply a value investing approach to, that I like to do as well. This is where I invest most of my money for that very reason. I feel like I understand the best of what I'm putting my money into when I buy into one of these stocks. These stocks typically pay nice dividends. They're your, for example, the ETF, SCHD, the Schwab US Dividend Equity ETF, it's filled with these types of stocks. The REIT space is pretty much almost entirely these type of stocks. The BDC space is pretty much entirely these stocks. The MLP space is pretty much entirely these types of stocks. And these are, again, ones that pay out a large percentage of their earnings and dividends. Hopefully they grow their dividends some year over year, but they don't have to. They're typically not going to grow super fast. Some of them do grow at double digits, but not much beyond, 10 to 15% a year if they're really growing hot at a time. And so as a result, because of the higher yield, they're not as speculative. You don't need to worry about, they're going to be able to grow at 20%, 30%, or even 10% for a long time. You just want to know, is that dividend going to be safe? And are they going to be able to grow enough on top of the dividend to bring you to a nice total return? And on top of that, again, because you can value them more precisely, because of the less volatility and uncertainty in the growth and the higher, more immediate return through the dividend, you can determine, is the market overvaluing or undervaluing this stock? And then based on what it looks like the market is doing in that regard, you can buy, hold, or sell the stock. And if you hold these, again, I like to hold them, except for the K1 issuing MLPs, I like to hold them in a retirement account because, again, the dividends then are protected, especially stocks like BDCs, that their dividends are typically taxed as normal income because it's interest income that they get. So it helps protect you from the taxation front. But then also you can implement an opportunistic capital recycling program of selling and, locking in gains, so recycling into undervalued peers. And you just can rinse and repeat that process to turn, maybe a stock that would deliver 8 to 12% normally in annualized returns into one that can deliver 15% or even higher annualized returns. In fact, following this approach, I've generated about an 18% annualized return over the course of many years. And so again, with that tax protection in the IRA, that helps facilitate that. And so that's another method that you can do. But again, you have to realize what stock you're dealing with there. You don't want to sell a really powerful growth engine using this approach. I've done it and I regret it. Okay, so that's the third one. Well, the third type of stock is a cyclical stock. And these are ones that are probably the easiest and the most profitable. I shouldn't say easiest, the most profitable. These are probably the most profitable for implementing a capital recycling strategy with. And that's because cyclical stocks tend to experience dramatic upswings and dramatic downswings in their stock prices. And the reason behind that is because they're cyclical businesses. And so when the underlying business seems to be entering a boom period, the stock market typically gets really bullish on it and the stock price soars really fast. But then when it seems to be entering in a downturn and facing headwinds, the stock price typically plummets. Now, guessing when these upswings and downswings occur is the hard part. And that's why I typically don't invest a lot in these stocks because, again, I feel like it's a bit speculative. But if you buy a quality one with a good quality balance sheet, good management, prudent capital allocation, a durable positioning in the industry, you can afford to be patient. And even if you buy a little early, you can wait and wait, and eventually it'll come back. And I've experienced that. But again, the key is strong balance sheet, good management, durable business positioning. Because if not, they could potentially get wiped out in the downstream in the industry. So that's a very important consideration to keep in mind. But again, these tend to be poor long-term compounders because of the cyclicality of the industry. It's hard for management to consistently allocate capital really efficiently. Inevitably, they're going to pay too much during the boom periods because the returns look too good. The worst management teams will over-leverage during that time. And during the downswings, oftentimes they're scrimping for cash. And so they have a hard time buying back stock during that period of time. They may have a hard time affording to take advantage of undervalued peers. Meanwhile, the upswing, again, they're over-leveraging, maybe buying back stock at high prices, and it doesn't end up so good for them. So these are the companies that tend to be not as good long-term compounders, but again, you can buy and sell the waves and collect some dividends along the way potentially to generate attractive returns in a capital recycling strategy, that is. Okay, so hopefully this video added some value to you. Hopefully it helps you understand which of the three you're investing in and how you should approach allocating capital. Again, I think that the growth stocks are more of a buy and hold type investment. Don't get too wrapped up around the value investing approach. As long as they're growing at a good rate, you remain confident in that. But beware if you start to lose confidence in their innovative and growth abilities, jump ship because their stock will plummet the moment the market comes to that conclusion as well. With the stalwarts, it's lower risk of that sort of scenario happening, but you got to watch the dividends and make sure the dividends are safe, the balance sheet is sound, and then implement a value investing and opportunistic capital recycling approach, ideally in an IRA, to maximize your returns from those. Finally, the cyclical stocks, again, this is probably the most speculative in terms of trying to catch the upswings and downswings, but if you insist on quality and the balance sheet and the business and the management, even if you get the timing a little off, it's okay. You can afford to be patient and wait. The time will come for that business again, and you'll probably end up okay. So again, hopefully that helped you. If it did, please subscribe to my channel, like the video, and let me know in the comments below what you think and how you approach investing. Thank you so much. See you next time.